Um, if you're here for Capital Stacks 101, blending grants and financing, then you're in the right place. And thank you for joining us for this inaugural webinar hosted by the Maine Resilience Finance Coordinators, which is collectively my organization, the New England Environmental Finance Center, in partnership with the Gulf of Maine Research Institute. Before I hand it over to my colleague Nikki Yannick at GMRI for today's talk, we wanted to cover just a few logistics on the next slide. Nikki, could you
There we
advance
go.
that
Yeah,
slide?
having some
There we
technical
go.
difficulties already.
Um, so yeah, as you may have noticed, we're recording the webinar. We will be posting it to the EFC's website and on our YouTube channel if you want to share it with anyone after the event. We will save some time for questions and discussion at the end of today's presentation. But if those come up during Nikki's content, feel free to just put them in the chat. Again, we'll answer them in the last 10 or 15 minutes. Please remain muted. I think everyone's doing a good job on that already, but feel free to join us on camera if you so desire. And next slide. Yeah, just to say a bit more about the Resilience Finance Coordinator role. As I mentioned, this is the first webinar of what will ultimately be a number of funding and finance related trainings that we're offering. This work is funded by the Maine Office of Community Affairs, and the Resilience Finance Coordinators are part of this broader Resilience Collaborative, which is a network of regional assistance providers across the state of Maine who support communities enrolled in the Community Resilience Partnership, in particular those kind of rural, underserved, and low capacity communities, to help plan, design, and implement climate resilience and natural hazard risk reduction projects. Our role, as the name implies, is specifically around strategies and support to fund and finance these types of projects. And to that end, we offer monthly climate finance office hours where you can come ask us anything. Depending on the number of attendees, we could go deeper, or it could be a sort of rapid fire Q&A. The next one of those is coming up in mid-August, and we'll drop that into the chat if you're interested in joining us or asking a specific funding question. We'll also be doing many more training and peer learning opportunities, both like this one online during lunchtime, but also in person and more intensive workshops and learning labs. And this program also allows us to offer some one-on-one direct funding and financing technical assistance, whether that's on funding strategies, application support, et cetera. Last slide for me, I think. Just to put some names and faces to that Resilience Finance Coordinator role, I'm Chloe Shields. I'm the Deputy Director at the New England Environmental Finance Center. I've worked over the years with communities on numerous federal and state, both grant and low interest loan applications for climate and also water infrastructure projects. I'm pleased to be part of this broader team. Hand it to my colleague Andrea to introduce herself.
Hi, everyone. Thanks, Chloe. I'm Andrea Berry. I am the Climate Funding Manager at the New England Environmental Finance Center. I've been a nonprofit fundraiser for more than 20 years and also serve as select board member in the town of North Yarmouth, and so have been playing this role in merging the strategies of fundraising and financing with the municipal world, and really excited to support all of you. And I will pass things over to our colleague Nikki, who's going to take it away for the rest of this presentation.
Thanks, everybody. After those great introductions, if we haven't met, my name is Nikki Yannick, and I am the Climate Finance Specialist and now also the Senior Program Manager for Resilient Solutions at the Gulf of Maine Research Institute. My background is I spent over a decade, I call it doing the Wall Street thing, as an impact investor, managing nonprofit endowments and doing manager diligence and research and portfolio management for mission-aligned investments. And then when I came back to Maine in 2015, I was incredibly fortunate to join Coastal Enterprises as a lending and investment officer and into the community development finance space, where I really learned how to sort of apply and stack both public and private financing, worked with small businesses as a lending officer, and then also supported the organization with royalty-based financing, venture capital, and other types of more innovative financial mechanisms. So at GMRI here, and in partnership with Andrea and Chloe and Maine Office of Community Affairs, I really am able to take those experiences both from the private sector and the public sector and get creative as much as possible with different financing strategies. And so that's really where the basis of this information came from. So we wanted to start with a relatively foundational educational material for what a capital stack is. And we hear these terms quite frequently in the climate finance space or in the public financing space. And capital stack is just really a more formal term for all of the different funding sources that come together to make a project happen. So one of the examples I like to give is most of us at some point are pretty familiar with either buying a home or a car and putting some cash down and then financing the rest. And that is a really simple model of a capital stack, right? You have your equity or your cash that you invested, and then the debt, which is how much you financed. And sometimes in there, you might have some tax credits, you might have some rebates. And so all of these different mechanisms together create a capital stack. So this image is not comprehensive, but a general idea of how some projects might be financed. In our world with climate finance, particularly working with communities, you might start with a grant, either from the state or the federal government or another philanthropic entity, and you will have likely a percentage match of that grant that might need to be either cash from the community or a loan or a bond. And then you might have some collateral, which is your physical assets. So in the event, in the example of a home purchase, for example, the collateral is the home itself, or a car purchase, the collateral is the car itself, some sort of asset that you are putting up for the purchase of for that debt. You might also have some cash revenue for the project that might come into play that will repay some of that loan. You might also have some tax credits or incentives that might come at the end of the project. And when we are looking at how to finance a different project, this orange box here is where we really see the most amount of flexibility and intricacy when thinking about how we're going to finance a project and where they all sort of come together in the cash flow of a project, which we will see a little bit later on. So here's some of the key layers that you might see in any given stack. So almost always we will have cash on hand, or what we might call owner's equity. These are any dollars that you are contributing to the project in the beginning, cash flow throughout the project, paying interest on a financing mechanism. It can also be an asset. So it could be the property that is owned that the project is taking place on, or machinery or equipment, really any asset that is anchoring that project over time. Many times in our world, we're going to be likely using a public grant, again, federal or state. Sometimes they will require a match contribution, which is your owner's equity piece, and then ongoing administration. That is also something that you are going to want to make sure you fully understand the rules, the regulations, and that commitment of the ongoing administration over time. Philanthropy often comes into play in some of these projects. You might see grants from nonprofit organizations or foundations. You might have something called a program-related investment, which we'll go into in a little bit more detail later on, a mission-related investment. And these are additional sources of capital that contribute to cash flow dollars over time. They may or may not require some sort of return back to the organization over time, but usually they are looking at below market return, so below a traditional loan or investment return. Loans are often very common in any sort of infrastructure financing or in a number of different types of projects. You might have a loan from a community bank or a larger bank. You might have a loan guarantee from someone like USDA. They are likely an institutional loan. They likely will require collateral or that asset that you're putting up to reduce the risk of that loan. And they also generally require something called priority repayment. So in the event that they are first debt or first priority payment holder in any given project, they will be the ones who get paid back first. In the event that the project doesn't work out or that there is some sort of problem or there's subordinated debt underneath it, they get paid out first before anything else. A bond is more commonly held as a public debt. It's just like a loan that a community might take on, especially in a much larger infrastructure investment. And these generally need to be voted on by that community. They are going to be packaged in a municipal bond bank, so they're going to go out to investors later on. They are a huge time commitment for the community to make sure that they are well researched and priced adequately, and they're generally paid from tax revenue, general obligation, or maybe a fee for service that is identified ahead of time when the bond is packaged. Tax credits often come into play, though they are sort of less and less these days. You might have a solar tax credit, you might have a low-income housing tax credit. There are a number of different opportunities. New market tax credits, you might be working with an economic development group, but they are generally a reimbursement for a program that you must hit a checklist for or an incentivization for. And they do come into play in the capital stack, but it is important to know that they come after the project is almost always completed. So they are something that you want to make sure you have the full capability of paying and financing the project ahead of time, but they are something that can be a great way to recoup some of the expenses and reduce the overall cost of a project. So we often see that many projects get started because of a public grant or program. These dollars, what we call anchor the stack, so they are sort of the biggest piece most of the time. They also can unlock additional capital that wouldn't have otherwise been available. So when you think of the total cost of the project, if the public grant can be over 50% of the project, it can often unlock and reduce risk for taking on a loan or identifying some other financing mechanism to support the project overall. So often the federal grants and federal agencies that we work the most with are the EPA, the FEMA BRIC program or the Hazard Mitigation Program, Department of Energy, USDA Rural Development, and other agencies have programs that are focused on a wide variety of different resilience and infrastructure. So this is some of the sort of key pieces and places that we look when we're starting to try to identify a way to pay for a project. Similarly, the state resilience funds through the Maine Office of Community Affairs and the State Resilience Office, Community Resilience Partnerships, the economic development groups often have different grants and programs to support resilience projects. If you're based in another state, there are different organizations that do some similar projects. Massachusetts has quite a few of them. Connecticut has their own infrastructure bank, as does Rhode Island. So it's really important to really cast a wide net in a search to identify what you're looking for, and then also identify various projects or programs that might be tangential to your project that can help support or reduce cash flow in other areas of operations so that you can redirect those funds. And we'll talk a little bit more about that later. Some of the tax credit programs that we see most often: new markets tax credits, low-income housing, solar, clean fuel production, clean electricity, advanced manufacturing, and more. Something that's not often talked about in these public programs are loan guarantees, particularly through USDA. A loan guarantee is effectively a backstop when you are doing a financing program. So if you were to take out a loan to finance a project over a long period of time. You are going to repay that loan, but in the event that you can't, a loan guarantee will be the one to take out that loan for you. And it's an unfortunate situation when that does happen, but it can de-risk a loan, so it makes it more likely that a lender will actually provide the money to finance that project because there is effectively no risk to them. So private philanthropy is Andrea's area of expertise, but it is a really critical component to making some of these projects happen. We often think of grants as the most commonly used method of private philanthropy. You might have a traditional non-repayable grant that could fund planning or design, sometimes implementation, but they really provide catalytic capital, so getting started on a project so that you have a better idea of a design and a vision for what you're trying to accomplish. Program-related investments are a little bit more complicated. So most charitable organizations or 501c3 organizations have some kind of endowment. And there is a general provision for endowments that they must spend approximately 5% of their endowment every year. And most of the time for smaller and mid-sized endowments, that 5% goes towards operations of their programs and staff time. But in the event that you have a very well-established or a much larger endowment, think Harvard, Robert Wood Johnson Foundation, Red Cross, things of that nature, they might have a little bit more opportunity and space within that 5% mandate where they might be giving grants out that are mission aligned. And a program-related investment allows a invested endowment to make a subsequent investment from that endowment to a revenue-producing project. And so they might be looking for below market rate investments. It's a very low return for them, maybe 1 to 3%, but it allows them to do a revenue generating project back to them. And this can be a really, really useful tool if you identify the right mission aligned project partner for some sort of revenue generating project, maybe a development or some sort of solar or project that is going to ultimately return some sort of benefit back to them. So those are not commonly used in a lot of programs, but in much larger developments or much larger programs for sort of catalytic change, they can be a really, really useful tool to dive a little bit deeper into. Similarly, in-kind match funding is a very overlooked component to some of these projects. So as an example, we'll see later on a project that I did where I provided in-kind match funding for a bulkhead rebuild. And this is services from a professional or an expert that are donated to the project as that match funding for a grant requirement. So in my case, I donated my time and we did all of the different letters of support and administration to demonstrate exactly how much that time was worth as part of the project so that we could access more dollars and more dollars were going directly to the project. And this can be something that you might have the benefit of an environmental engineer or an environmental nonprofit or similarly related organization that is interested in helping you achieve your goal, and you can make that connection to sort of open up a few more dollars to those grant requirements. So why do all of these things matter in private philanthropy? Philanthropic capital is very low barrier and can help incentivize and access additional private dollars. So it's really important to sort of have that capital as your rock and your foundation moving forward so that you can access bigger dollars for larger projects later on. Bonds and debt. This is a very difficult slide to do in a very short frame. There is so much to discuss when it comes to bonds and debt and financing and loans, and we can get into that, but I wanted to cover it at a very high level for really what happens in these projects. Bonds are commonly used financial mechanisms for communities. We often see them for infrastructure, road repairs, major investments that you're paying over a long extended period of time. They require legal counsel, they require public votes, they require extensive research into the estimates and sort of the knowledge of exactly how much these programs are going to cost and the long-term maintenance and sort of all of the other eccentricities of a project to really understand how much you need to finance. Um, and that's the same with taking on larger loans and debt. So understanding the total cost of a project and alternatively the cost of doing nothing is imperative to the success of any financing strategy. You really want to understand the total cost of construction, including contingencies and the cost of labor, the cost of overhead and administration for a project manager or the community itself, the cost of the interest and the financing over time. And then is going to be your total project cost versus your total cost of doing nothing, future costs of the total project. So your inflation over time, how much is it going to cost you to do this project in X number of years? Is there going to be additional damage that's going to make the project a little bit more expensive? And really understand what the total costs and matching up that time frame look like. So these are just a few other financial mechanisms that we see in different capital stacks that maybe are not used quite as frequently. Green bonds, resilience bonds, they might sound pretty much the same thing, but it's really just a label that is used for an investor to be interested in these types of bonds. They might generate a little bit more interest in certain markets. They might have a little bit of a higher return on them if they're a little bit more risky. You might use PACE financing or property assessed clean energy financing through tax assessments. It's effectively like a TIF for a specific property when you're making energy improvements. Tax increment financing commonly used in communities and municipalities, which really takes the potential of future tax revenue gains on a project and pre-invests them into a development. Environmental impact bonds, which really is less of a financial mechanism as it is a sort of impact incentivization. So they're a little bit of a misnomer when it comes to calling them bonds. And then revolving loan funds. So that could be public or private capital that is recycled over time and invested into resilience types of projects. So in practice for doing any type of capital stack or project financing, you really want to look at the wide variety of phases. Your pre-development phase is planning, feasibility, design, and this is a really, really critical phase to understand your total costs and do as much research as you possibly can. Get your stakeholders in place, get the right team in place, who's going to do the work. This is often funded either by a public grant or a philanthropic opportunity. And then you're going to have your construction. That's really where debt and financing come into play. That's where cash flows get really, really important. Then your permanent and your takeout phase is after construction when you're sort of doing your cleanup financing phase. So the loan is coming due, you're switching it over to either a permanent debt financing, bringing in those tax credits and incentives and rebalancing your financing over time. Maybe you're switching to a lower cost permanent financing, and then your closeout. So what your revenue looks like, your ongoing maintenance over time, maybe a sinking fund, which we can talk about a little bit later, but that's your sort of ongoing costs of maintaining that project. So this is a very simplified example of how I might look at a project's financing over time. So I really sort of cleaned up what I would call a pro forma, but effectively these are down the side your different phases of projects. So your vulnerability assessment, your feasibility study, grant writing. You might have a public grant and match here in this. Your pre-investment phase, planning and approvals, your legal fees, your impact assessments, your permitting. Here you might have a construction loan and maybe a public grant if there's something specific that you're building that there is funding available for. I'm thinking the boating facilities fund, brownfields, things of that nature. Your phase 4, your actual construction phases. This is really, really critical to have so much information right down to the hours that everybody is going to work for site clearing and oil testing, or excuse me, soil testing, your materials, your structural construction, your mechanical, electrical, plumbing, labor, solar installation might be a piece of this, your utilities and your hookups, all these really intricate details. And you also want to make sure that you have at least a 20% contingency because these This is where really the budget can go off the rails for things that are unforeseen. And then your phase 5, your closeout and your monitoring, you might have ongoing grant reporting that you need to account for that time and professional services for an individual to make sure that that's done correctly. Tax accounting, your financing costs, so paying the interest over time or those loan payments over time. You might have a credit or incentive come into play here. And then you have your ongoing operations. So you might be still financing a loan or a bond payment. You might be now hiring staff to implement a project, things of this nature. But over time, you're going to see, and the project timeline sort of tracks across the top here, and I have that as months, but you're going to see where all of these different inflows and outflows happen and the different pieces of any financing stack come into play. And if this were one of my projects, for example, every one of these cells would be full of accounting figures so that I am accounting for every cash inflow and outflow of every source and use so that I can account for each piece of that over time. And then I know exactly what my inflows and outflows are over those months. And then that's where you're going to know where you're going to have to come up with your cash or owner's equity to fill in the gaps over time. So we get this question a lot. What is the difference between blending versus braiding your funding? So in a blended funding example, you are going to have all these different components of your capital stack sort of merged together in one total fund. So thinking about it as sort of one checking account where all of the funding is coming into and you are simply paying those projects through that. That can be much easier to do, but often doesn't necessarily make your life any easier because you need to make sure that every loan and grant is accounted for separately. And oftentimes, sometimes that's not necessarily the case, but sometimes it is. So a blended is where everything sort of comes together against one total project cost. And braided is where you have these distinct line items of a project. And it could be the phases of the project. It could also be something more specific, like the purchase of machinery or equipment versus the site planning and the engineering and the construction, and all of the different pieces that make up the totals for each one of those buckets. And you are going to have your own reporting for each one of those pieces. There are going to be restrictions and requirements for each one of those pieces, both on the phased side of things, so what you're actually paying for, and also what the funding sources are themselves. So this is where I sort of have more of my expertise is in the braided and how everything comes together. And it's really, really important that all of those timelines are tracked very, very closely. They're each going to have their own cadence. They're going to have restrictions and they're going to have eligibilities, and you're going to have some of the components of financing might be reimbursement based. So that comes into play with how you time things. So there's a lot of different moving pieces here, which is why we think of it as a puzzle and not necessarily a simple stack. So these are some of the most common pitfalls that I see in any type of project. And the first one, any project manager will see this every single time: underestimating how much money you need upfront, how much money you need to plan your feasibility. You might have to do multiple designs. You might have to go back and get different permits. You might have to go back and get different approvals. That takes a long period of time, and that is often under budgeted before you even get to the actual piece of building something. Again, misaligned timelines, grant funding cycles don't often coincide. I see this all the time. It's really frustrating, but it's a bit of a chicken and the egg situation when you have the funding opportunity come and when you're ready for the project. And so you almost always have to be ready for the project, which means that you have to make sure that that pre-development capital is ready and going and your owner's equity is well tracked ahead of time so that you have all those pieces when the opportunity comes, either for a grant or a specific program that will help you finance the rest of the project. Over-reliance on one source. We often see that, particularly when I was working in working waterfront type projects, that they would be all in on one public funding source that came available to them, and really not think about the match requirement or not think about the long-term construction or not think about the long-term maintenance of this public asset. And often one grant is not going to cover any single project. So you need to make sure that you have diversified your income streams. You might not always get the grant. You might not get as much as you asked for. So you really have to make sure that you are well covered or over covered for the project that you're thinking about. And this aligns with sort of all of these different pieces, but no contingency or reserves. You will always go over budget. That will almost always happen. I've never seen a project come in under budget. There will be change orders. You might run into an issue with supply chains or the price of materials. We saw this a lot during the pandemic. You might run into labor overcharges. You might need the construction company or your subcontractor might not be able to come in the timeline that you have laid out. And so these are all really, really critical pieces and sort of underline the need for that contingency for that cash capital reserve and really, really planning ahead of time to make sure that you can match and master those different pieces when you fall into a gap. So we're going to get into some of our examples. And Days Ferry Bulkhead was a relatively simple but a unique project for me and one I really loved doing. The bulkhead is over 300 years old. It is one of the main public access points to the town for commercial fishermen, local recreation activities, and also some emergency services. It's access for the fire department to get water in that part of the community. And these timbers, like I said, are over 300 years old. This particular project, we tried to go for a FEMA hazard mitigation grant, and it checked all of the boxes. So we were really excited that it was going to provide at least 75% of the total cost to do this project. As we went through it, we started to run into some concerns with the cost benefit analysis, and that really was anchored in how old the timbers were and not being able to accurately account for that cost benefit analysis within the framework of hazard mitigation, which made it really, really challenging. And FEMA was going through its own challenges at the time. So we ran into a timing issue in terms of actually getting the funding and getting approvals. We were very fortunate that the Public Working Waterfront Infrastructure Grant came into play. And so we sort of switched gears and went to that grant instead. In this particular case, our match funding was the grant writing, administration, and some of the planning and environmental engineering that came into play because a community member who lived in that neighborhood was an environmental engineer and did a lot of the preliminary feasibility so that we knew ahead of time what the design was going to be. And those were all donated services to the community. And then that allowed us to really maximize the construction phase and the final plans and engineering and sort of ongoing work for the bulkhead to be all grant dollars for the community. So that was one of the projects that I worked on and was somewhat unique, but that's where in-kind match funding really can be hugely beneficial in terms of getting up and going, that philanthropic component of the beginning phases of a project. So we have the Saco, Maine Resilient Wastewater Treatment Plant. This is something that Chloe and Andrea were working on. And this, I'm sorry. Okay. Well, I have a bit of a mistake here. I'm sorry, I'll go through it. But this was the project where we had stacked loans and grants to upgrade and relocate the flood vulnerable critical wastewater infrastructure. And this was a 20% grant and an 80% loan project. And there were the Clean Wastewater Reserve funds, or the revolving loan fund that was critical to this deal, but the 20% was partially a forgivable grant and partially funds from the community. So a total of $50 million as an estimated project cost. And we needed to borrow money from the state revolving loan fund, but there were more favorable terms in a municipal bond market. So the community really had an opportunity to do one of two things: to go to the municipal bond market and finance it on their own terms, or to go to a program-specific fund that would allow them to take on this debt over time. And because of the timing, the more favorable terms were with the Water State Revolving Fund. But there are some projects that it might be more beneficial, depending on the flexibility of the capital, to go with a bond in and of itself. Okay. This is another unique project that I worked on. This is Garrison Cove in Harpswell. It's one that's near and dear to my heart. It's right next to the Cribstone Bridge. And sometimes it's more than just dollars in a capital stack. In this case, it was actually the business model itself that we stacked. So this project was a USDA awarded in 2023 to understand how to diversify business models of working waterfronts to make them more resilient and more sustainable in the future. The study yielded a number of recommendations, but was rooted in making a working waterfront more diversified between not only its use, but its revenue streams that would allow them to be more sustainable over time. So in the first model, you're going to see the original sort of what we call stack or the use case of that working waterfront. We have an anchor tenant, which is Eastern Traders, they're a lobster processing facility. We have local lobstermen who rent slips from the space. And then we have the wholesale Portland Lobster Company that was getting the majority of their lobsters for their restaurant here in Portland from the wharf. And what makes this really interesting is the actual purchase of the wharf was the owner of Portland Lobster Company, because the difference in savings between getting the lobster from boat price to wharf price, which is a little bit of a difference depending on who owns the wharf, was enough cost savings for him to actually finance the purchase of this wharf. And so that was really the impetus for him to take on this responsibility. But over time, we recognized that there was a real risk to the business model because we were so focused on one species, one entity for this particular project. So we did a little bit of work with the community, and the town of Harpswell needed a new space for their harbor master. And at the time, the harbor master was operating out of the town office on Mountain Road, which, if you don't know the topography of Harpswell, that's okay, but it's one of those towns where you can't get there from here. And it's really 4 different communities, a wide variety of inlets and coves, and it's really challenging. So the harbor master at the time would have to drive 20 minutes to be able to get on their boat, and they were sort of locked into a cove. It might take upwards of 30 minutes to 45 minutes to get to an emergency in the event that they were needed. Garrison Cove sits at the very southern point of Harpswell and really has access to all of those communities by going north and into the sounds and into the coves. So by bringing the harbor master to this space, we had their boat docked right there on site, and they were able to get to any emergency within the town in a much faster time frame. So it was a huge advantage for safety and emergency response. And that also allowed us to make a case for a private working waterfront that they were eligible for services, both for emergency response services and for public benefit. And so again, it's not always about the dollars. Sometimes it's about the use cases as well. So some of our key takeaways, no project is going to be fully funded by 100% grants. I often make the joke that people think that Chloe, Andrea, and our colleague Alan and I have this secret stash of money somewhere, and we will know how to finance everything 100%. That's just not the case, as much as I wish it were. You have to be prepared to invest in your project. You want to focus on the project vision. What problem are you trying to solve, and who will benefit from the project investment over time, and really be able to answer those questions prior to really digging into the design. That's really, really important. There is no substitute for the investment of time to make sure that you've done as much research as possible, that you've done your estimates, all the different possible sources of funding, which are a moving target, who your key team players are going to be, who your stakeholders are going to be, and who's going to get you across the finish line. But you do want to make sure that you keep track of all of that time, because that does come into play quite frequently and is sort of a lost source of match or a lost source of funding that is not reimbursed if you're not keeping track. The project doesn't always end after construction is complete. You want to make sure that you're thinking about your ongoing maintenance, your useful life of machinery, any installations. You want to think about what sort of requirements the grants are going to have for reporting over a long period of time, and what your long-term funding strategy is for any ongoing maintenance or needs that are going to be related to the project. So with that, I will start to open it up for questions.
Great. Yeah. And if you want to come off mute, feel free to ask your question live.
Hi, Nikki. This is Ann Fuchs. I serve as the Mitigation Recovery Division Director with Maine Emergency Management Agency.
Mhm.
And first off, thanks for hosting this. You're a hugely eloquent speaker. I mean, it was really engaging. And I was interested in joining this webinar because I mean, I was pleased to see you had the FEMA hazard mitigation assistance side of the house, but when it comes to disaster recovery, the public assistance grants that FEMA works through our organization down to the local level for reimbursement after disaster damages poses a lot of challenges for municipalities. So our team is often posed with questions about like, well, how do I make this work? And so what I've been trying to gauge throughout your presentation is you seem like you're the subject matter expert here. I want to send everybody your way, but
So
realistically,
thank you.
it's on a very tight time frame. And so
Yeah.
I've been kind of trying to figure out how to pose a question to you, but given the
Mhm.
circumstances of these municipalities going through disaster recovery and working with FEMA, which is a reimbursement grant when it comes to public
Yes.
assistance,
Mhm.
um, what are your recommendations for municipal leaders in those situations that have to address, public safety concerns on tight timeframes on how to go about funding things? Is it just to reach out to you, or what do you think?
Actually, I think I might be one of the last people that they should reach out to. Not because I don't want to help them in any way, but I really think that in terms of like what you were mentioning, the tight turnaround and the fact that it is a reimbursement, the community needs to deeply understand what resources they have in-house right now to tackle the problem, how they're going to make sure that everything is organized and tracked over time so that they can sort of demonstrate the need for that reimbursement. But I would say the most critical piece is who's coming to the table that can help them truly understand the costs, the needs, what is going to be needed to be implemented over time. So in the case that I showed with Woolwich, we were incredibly fortunate to have an environmental engineer, flycatcher, right there in the community who was well aware of this project. We were also had a construction company that had expertise in this area that was well aware, and they were able to come to the table and provide their professional opinions and expertise and estimates very quickly. That allowed me to have confidence in the numbers, confidence in who was going to do the work. And you still need to go through a public process to make sure that all of those resources and contracts are sort of held appropriately. But to have the right people at the table ahead of time saves so much time and so much money in terms of getting those estimates and those plans in place.
Thank you. I think that works really well for some of like the resource heavy portions of the state, but for the resource deficient portions of the state where it's like a town manager that's also your road
Mhm.
commissioner, that's
Yeah.
like your main public safety official. Um, and there are circumstances where we hear like they can't secure a bond. So
Mhm.
I have no guidance from them at that point, and there's just no resources actually coming to the table. At that point, and I see Alan just raised his hand,
Mhm.
I'm wondering what recommendations might be for those types of circumstances.
I think in those circumstances, reaching out to a group like Art, myself, Chloe, and Alan through Climate Finance Office Hours, or even to MOCA directly and the State Resilience Office, they will have sort of the fastest available knowledge and institutional knowledge of who needs to come to the table to support that community, and then how we might be able to get them all there. Alan, do you want to speak to that at all?
Sure. First of all, thank you very much for doing this. And every time I listen to you, Nikki, I learn something. And I do have a question, but first I want to
Yeah.
venture an answer to Anne's very good question. And I think one of the things that I've observed, I know one of the things I've observed in different towns is that some towns increasingly are putting together a reserve fund so that they can advance the funds for disaster recovery before the reimbursement comes into play. And that is, as you have indicated, not always possible for a town, but I think that there's a growing sentiment that this is money well spent to set up a reserve account. Sometimes it's even called a climate resilience account, so that a town is prepared to make the initial investment. and also qualify for the local match, the non-federal, the non-state match. Again, that's a challenge, but weather patterns are forcing us to think in that pattern. The other thing I've understood from some towns is that often they can find a local bank that will provide a letter of credit, and that gives the town the comfort of knowing that they can have quick access to what Nikki described as those contingencies. I hope that is somewhat of an answer, Anne, and it's certainly not a total answer, but it's what I've observed in some towns.
Thanks, Alan, for that plug too. We are going to be hosting a webinar on resilient sinking funds and sort of a savings account for these events. So stay tuned for that because we're going to do an entire webinar focused on that. And I don't know if I answered your question, and truthfully, it is a really challenging one because I wish we had sort of a volunteer core of experts and specialists who were ready and willing to provide some of these services and get these communities the help that they need and get them ready. But it is a huge challenge.
I'll just come off mic to say that was hugely helpful, Nikki and Alan. I can confirm, seeing a lot of interest in municipal like disaster recovery funds. That takes time to grow. I think a lot of municipalities learned hard lessons between the December 2023 storm and January coastal storm and 2024. Those are big ones for Maine. So we are seeing those positive changes, but it's still an uphill battle. And I at least have an idea as to additional resources to help guide towns. So I thank you all for that. Thanks so much.
Yeah.
And
thank you
can
so
I
much for
ju-
your work, Anne. Oh, sorry, Alan.
I was just going to jump back in, Anne, and I remember, was it a year or two ago, you were working with the federal agency to try to capitalize a state revolving fund that went beyond the clean water and drinking water revolving funds that we have. I don't know if there's anything new to report on that. I know that a number of our towns in the Blue Hill Peninsula were very supportive of that, and that may not be in the offing right now, but I think it's a good idea.
Just to provide a quick update from that, and then I'll open the floor for others, is that was the Safeguarding Tomorrow revolving loan fund.
Right.
Clearly, FEMA is one of the federal agencies that's been a bit tumultuous under the new administration. So that was, we submitted our application for that on behalf of the state of Maine to kickstart the Safeguarding Tomorrow revolving loan fund in September of 2025. And then I want to say it was like January or shortly after, FEMA had to pull the notice of funding opportunity. So we are understanding tentatively from our FEMA Region 1 friends that the new notice of funding opportunity for Safeguarding Tomorrow should be released in August. And if we follow trend with some of the other FEMA grant programs that have been rescinded and then re-released, we're expecting to have to reapply under the new notice of funding opportunity. So once more information comes out about Safeguarding Tomorrow revolving loan fund, we'll let all of our partners know. But at this point, we're just sitting tight and waiting for that notice of funding. We're hoping for it at the very least.
Good.
Thank you, Anne. Just a quick answer for Alex, who owned Garrison Wharf before the town. The town actually doesn't own the wharf. It's still privately owned, and it has been, but they lease space from the wharf for the harbor master to have access and keep their boat there. And it's, as far as I know, it's been a great success having the harbor master just have so much more access to the community. So her office sits upstairs above the lobster processing. Any other questions?
Nikki, unless somebody else has a question, could you go back to the slide that shows your month-by-month progression? I found that fascinating.
Yep.
The reason is I'm in the throes of a quarterly report, and you mentioned that for each of these cells, you have a list of income and outflow. Is that correct?
Yes.
Wow.
I thought it would be,
It
I thought
sounds
it
like a
would
good
be
lesson
overwhelming
learned.
if I were to do that. But effectively, in any of my projects, I break it down by as granular detail as I possibly can for any given project, start to finish. So everybody who's working on the project, every stakeholder, every subcontractor, every line item all the way down to when sand is delivered and all of these different pieces, every application. And you would see additional columns for a budget, an actual, and a spending and remaining for all of the funds. So as you go through from example, month one, it would be every inflow and outflow that occurred in that month, for every line item. So I could track where the money came from, how it was sourced, and where it was spent. And you would see totals for each one of the months. So it should balance to zero at every single month. I would add income for owner's equity or any amount of cash that had to be invested. I would add any reimbursements for grants, and I would also carry. So if owner of the project, for example, had to spend cash before it was reimbursed, you would see that tracked. So every single one of these cells would be filled with my inflow and outflow.
Wow.
Yeah. But I didn't want to make it completely overwhelming. So in this example, I just had sort of where the sources might be in different phases of the projects and how you might be funding different parts of it.
Thanks. Very impressive.
Marina?
Hey Nikki, thank you so much for that presentation. That was such a helpful overview. In your list of sort of like common pitfalls that you see, you mentioned underestimating that pre-development capital as one of those sort of key issues that pops up. Do you have any recommendations for like a buffer or like a percentage that you try to get people to think of, or any advice around this pitfall that you could share with us?
In my experience, it really varies based on the project, whether you're doing sort of a small rebuild or repair project, or you're doing a much larger infrastructure investment. But making sure that you are accounting for all of the different stakeholders and sort of participants' time is really important, and where that funding is coming from originally. Even if it may or may not be reimbursed in the future, you want to make sure that it's all accounted for. I hesitate to give a number because it does vary so much, but I would, if I had to estimate, I would say about 20%. And sometimes you might have, like, we have the opportunity through the Community Resilience Partnership for vulnerability assessments. In communities, those are really, really important. That might be a grant. But you might also have community match funding through that as well. So making sure that you are well prepared going into any project with as many estimates and as detailed plans as you possibly can is really, really important.
Thank you so much.
Nikki, if you want to leave folks with the last slide on our office hours too, if questions aren't coming in the next 5 minutes. And just commenting on that, the other comment in the chat about a deeper dive into how to establish a reserve fund, particularly in a small community, as being of interest. I think Andrea mentioned in the chat that is on our radar too. That's something we're hoping to offer this fall, so stay tuned.
And as it stands right now, we're planning on sort of how those funds are identified, where you might find additional sources of capital to pad those funds, how you might track them, how you might communicate with them out to your community, all of these different sort of pieces. But that's going to be, I think, hopefully a really beneficial opportunity for communities sort of to be a little bit more independent and more responsive to what their needs are specifically. If nobody else has questions, please know that you can always reach us through email, through Climate Finance office hours. We're here to help as best we can, and I'm happy to give everybody 5 more minutes of their lunch break back if we're ready to do so. Yeah, and please feel free to give us suggestions on other webinars and other topics that might be beneficial to everybody. So thank you all so much. I really appreciate it. Have a great day, everybody.